Welcome to Jill on Money, powered by The Compound. I'm Jill Schlesinger. Hey, Mark, you're on the same side of the table. What gives?
Yeah, I think we have someone special joining us today.
This is so exciting. It's like a little bit of Lollapalooza. It's like we're going to Warren Buffett's annual meeting. This is, for me and Mark, one of the most exciting and much anticipated guest appearances of the year. Today, we are joined by none other than IRA legend, Roth IRA legend, Ed Slott. Ed, what is the title that you like to use? Like the founder of Ed Slott and Company? Or what do you want to use? Bring it on.
Ed Slott and Company, IRAhelp.com. And thanks for that buildup, but you just took away my secret weapon.
Oh, what's that?
Low expectations.
Oh, no.
Yeah.
But of course, Ed, being a New York sports fan, has had low expectations for many years. So
we live with it.
We understand.
You know how
that.
I enjoy football, being a New Yorker? I root for other teams to lose.
That's exactly right. If you can just live your life rooting against the Patriots, everything's fine. I understand.
No, they're gone. Now it's the Chiefs.
Oh, no, I would never root against the Chiefs. Let's not talk about that. Right. It's terrible. Okay. Ed, we are having you as we sit down and speak. It is the end of February, which means we are talking high tax season. So, what do people need to know about filing their 2023 taxes that is important for this year?
Nothing. People ask me that all the time. All you're doing is recording history, things that already happened. What you should be looking at is the woulda, coulda, shoulda. You know, for years as a tax accountant, luckily I figured this out in my late 20s and early 30s. People used to come in, I did their taxes, and I would always be the bearer of bad news. I would look at it, if you only did you should have done, if you only did this whole woulda, coulda, shoulda. And I realized all I'm doing is recording, being a history teacher, looking backwards. There's a big difference between tax preparation, which is what people are doing now, and tax planning looking forwards. So if anything, learn from what you're doing now so you don't have this woulda, coulda, shoulda every year. There's almost nothing you can do now that will change, other than having a time machine, that will change last year, other than making maybe an IRA, a Roth IRA contribution, which you can do, and it'd be effective for last year and do it up to April 15th this year. So if anything, look at your return and look at all the opportunities you might have missed, like not taking advantage of these super low tax rates.
Let's do this. So first of all, I want to say that every year that you have come on this program, and Mark, what did you say? How many years has it been? 10?
It's got to be at least 10, yeah.
We dragged him into the studio at CBS year after year. Then we did some COVID episodes. Then you did a webinar with us. And now
look at this beautiful
place.
It's
gorgeous.
We're
in the Compound studio. It's fantastic.
I got Bryant Park behind me, the library.
Yeah, everything is good, right? Now, as we talk about taxation, I thought it was amazing because every year when you come, you bring me these gorgeous tax charts.
Yes.
And you have a brand new one. I know you're going to put a slate up, but I'm just going to do this. I'm like, hey, gang, we're going to talk about this. This is a history of tax rates in the United States.
Yes.
Now, I notice you go back to 1913, which is good. That's when you and I were in high school, right?
Yeah.
So what is important as we look at the top federal income tax rate by year? What do you think pops out on this chart?
Well, the key word is history, because you have to look back at history. Everybody complains about taxes. Nobody likes paying taxes, but they're going to have to be paid. So what I do is I use this in seminars, and I tell people, look at history. These are the good old days. You don't realize how good it is now. We're in the lowest tax rates most people will ever see in their lifetime. So in this chart that you're showing, I highlighted the years the baby boomers were born, just as a frame of reference, 1946 through 1964. The top federal tax rate for each of those years exceeded 90%, except for the last year, 1964. That's when the Beatles came to America, and I guess everybody got so happy they lowered the top federal rate all the way down to only 77%. And I don't really know, I was only 10 years old, but I hear the whole country did a happy dance. Oh, only 77%, happy days. That's more than double today's top rate.
But you also say that during that time, very few people paid that 91%. What was happening in that time?
Well, you had massive types of deductions, which we don't have. So we have lower rates, but we also have almost no deductions anymore. If you look what they did in the recent tax law a few years back, they doubled the standard deduction and raised it every year and every year. Now, according to the IRS, over 90% of the people use a standard deduction. Almost nobody has deductions anymore. Even if you have a mortgage, you're in New York like here, big deal. You pay taxes. You're limited to $10,000. The state local taxes, what they call it,
SALT.
Yeah. Nobody gets that. I don't care how many state and local real estate, state taxes you're paying. So when it comes down to it, unless you have a load of charity or, unfortunately, a load of medical expenses, you're going to use the standard deduction. And we're in a financial company here. You don't even get to write off your financial advisor fees.
So when you look at that, just out of curiosity, I'm sorry to interrupt, is that a fairer system? Is it a better system?
It's a simpler system for most people. They got rid of all the job and, as an accountant, when I used to do tax returns, that was the toughest thing, to get all the job-related expenses, your union dues, this, traveling to work. Was this for work? Was this personal? How much did you use the car? Personal business? You had to go through all of these things. Now, most people are getting higher deductions than they had otherwise.
So is that a good thing or a bad thing?
I think it's a good thing because people complain, the people that do complain, saying, I lost all my deductions. The ones who had the highest deductions, they didn't realize it. They didn't get them anyway due to the alternative minimum tax. I used to have tax clients say, you forgot all my deductions because I didn't put them down. So then to stop all the calls, I used to put them down on Schedule A, list all the deductions. They didn't get them anyway, but at least I didn't get the calls because they saw it on the return. They thought they got them. But even the state and local taxes, you didn't get them anyway because if they got high enough, the alternative minimum tax wiped them out.
It was like a second tax
Yes.
system. Okay.
I was going to ask you, 91% federal tax rate sounds absolutely insane. When you factor in the deductions from back then, what do you think it was in reality?
It was way higher than it is now. And not everybody had deductions, and most people were in the lower brackets. Remember, this chart, the key word there I said was history, but top rates for the top earners. But still, the top rate today is only 37% compared to 90. I mean, it's a big difference.
So if you look at 2024 taxes for this coming up year, and we'll just put this up because this is for the current year, and you look at it says that the marginal tax rate, and you're going to remind everybody that you don't pay. Everyone's like, oh, I'm in the top bracket. They think that goes back to $0.
No.
It does not. Okay, so it's a graduated. Okay, but what's also interesting, and you pointed this out before we got on the air, is not just that the tax rates, the marginal tax rates are low, but the range is wide.
The brackets have expanded. Yeah. And who do we have to thank for it? Inflation. Everybody complains about inflation because it does mean prices go up. But when it comes to taxes, inflation's great because each year they have cost of living adjustments due to inflation that expand the brackets. The rates don't change, but more money can pass through a low 22, 24%. Who ever heard of these rates?
And those brackets, when inflation, let's say, goes back to a more reasonable level, right? It's not like the brackets are going to get smaller.
They'll never get smaller.
They never get smaller.
It will just increase by less. The year 22 to 23, we had that high inflation. The brackets swelled up. I think the inflation rate was like 8%. Now it's down to 2 or 3%, something like that. So, but you still see expansion of the brackets.
And in that respect, because those brackets are so wide, you are seeing, for example, like you can make almost up to, let's say if you're married, $384,000 for this year in 2024 and find yourself in the top bracket of
Only
24.
for the top tier. Remember, you still get some at 10, 12, it's graduated.
What is the effective tax rate that people need to keep in mind when they start complaining about their taxes? How do they figure that out?
Well, all they have to do is take the actual tax over their income, and that's the actual effective rate.
And if you're let's say, a middle
It
class
could be
earner,
15, 20% for a
Exactly.
lot of people.
That's-
They look at, oh, I'm in the 24. That's just the top dollars. That's what we call the marginal rate, the tax rate paid on the last dollar of income.
a lot of the people who are watching this also have brokerage accounts.
Right.
And they want to talk about capital gains. So tell us a little bit about where we are in the capital gains rate history.
All right. On the capital gains rate, which you'll see on this chart, there's a 0% bracket for long-term capital gains here. And it goes up to 94,000. That sounds great. And you hear people say, oh, I pay 0%. No, almost nobody gets the 0% rate. It sounds good because the way the tax law works, it's sneaky.
How?
Yeah, because ordinary income gets taxed first. So if you have a job that pays 50, 60,000, or you do pensions or IRA distributions, and it goes up to, say, in this case, 94,000, you're out of the 0% bracket. It uses that up. Most people fall into the 15% rate for long, but which is fantastic.
I was just going to say, so still good. Now, let's say Mark tells me to buy NVIDIA at the beginning of last year, and we make a bunch of money in this stock, and we sell the stock. Now, is the gain of that stock included in the income level?
Yes, but it's taxed on a separate, a separate rate chart.
So let's do this. So let's say that Mark and I were married. Oh, God, it's so beautiful.
For taxes.
You do it for taxes. We're doing it for taxes. So we're married, and let's say together we make $200,000.
Yeah.
Okay. We sell $100,000 of our NVIDIA stock. What's the tax rate going to be on that?
The 15%.
Just 15%. Now,
assuming you don't get any of the zero, you're not going to get the 0% because
Right.
you just told me you had.
right. Now, what's the extra 3.8%?
Oh, yeah, that's
I'm sorry.
the sneaky thing. That's the thing. That's the net investment income tax, something we used to call it the healthcare taxes, which was supposed to, I don't know if they were supposed to be temporary, but it never seems to be anything temporary in taxes. In fact, if you go back to that history of tax rates, back in the negotiations for the 16th Amendment, when it started in 1913, they had this, I think it was 7%. You have it in front of you, 7% rate. And some of the congressmen back then said, I don't know if we want to open this Pandora's box. We haven't had an income tax. And they said, what? It'll never get over 10%.
Never.
And it only affects like 7 families. It was meant for the Rockefellers, the Carnegies, the Vanderbilts, and that ilk. And they said, it's only for those like 7 families. Don't worry about it. So they didn't put a cap. Now look where we are.
Well, and then so I'm just going to say that there is this, this is in the investment income,
Yeah.
the magic chart of
Yeah.
the surtax. What
Now,
is
that
this
is
meant to do?
sneaky
What is that
because
supposed to do?
It's supposed to tax passive income, interest, dividends, capital gains, things we were just talking about, for an extra tax when your income goes over certain thresholds, which are high thresholds: married, joint, 250, single, 200,000. But what's interesting about this provision is that it's never been indexed for inflation.
Yeah,
So,
that's what I'm wondering.
Yeah, it never was. So you end up paying more of that. And also self-employment income, there's a version of that for this. So they get a little of everybody on here, and they get a little more because as your income, goes up for inflation, this doesn't. It's very similar. There's one other provision. Do you know it that was never adjusted for inflation?
What was not adjusted for inflation?
The tax on Social Security.
Oh, right.
And that is so low. People say, oh, we always talk about, oh, your Social Security is going to get hit at 85%, not 85% tax. People mistake that. Up to 85% of your Social Security benefits can be taxable. Taxable can be taxed. And people say, well, I want to get under that. You'd have to be at the poverty level now to get under that.
Because that number was like 45.
44, something like
that's
that.
Nuts.
Right. But it was never, and it was done over 20 years ago, maybe even longer, maybe 30 years ago now. And they said that would be, that we would never tax your Social Security. And people never forgot that. I do a lot of consumer seminars. And when I talk about the Roth IRA, I always get a question, will they ever tax Roth IRAs? They did that with Social Security. I said, that was 30 years up, but I don't forget.
Oh, my God. They never forget. So if we look back and you're filing right now, and, I guess a lot of people want to know, I'm a W-2 wage earner. Do I need to have a CPA? Do I?
Well, it depends what else is on your return. If you just have a W-2 and some interest and dividends, and you're taking a standard deduction, which most people do, it should be easy. But if you start with a Schedule C, you have a small business, or you have rental properties, or you have pass-throughs from little corporations, LLCs, partnerships that you might have, then it gets a little complicated. And if you have high investment income, we talk about this 3.8% surtax on net investment income, you might start doing your taxes and say, what is this tax?
Mm-hmm.
Maybe I should get a CPA?
Well, you actually are married to a CPA. Mark's wife's a CPA, by the way.
Okay.
But she does
In-house.
not. Yeah, but she does not do taxes.
No.
I don't blame her. I got out of that racket years ago.
So one thing that we're often asked about, I wonder if we can spend a little time here on this, is how we can compare different types of retirement plans, especially for self-employed people.
Yeah.
We have a lot of people who were watching from the compound our earlier show and said, hey, what about if I'm self-employed? What if I have gig income? How do you bring together this idea of like, okay, let's say I work for a company, I have a 401k, but I have side hustle. I have some investment. I have some self-employment income. I'm making a bunch of money. What can I do with that?
A bunch of money is subjective.
Okay. All right. Let's okay. So let's see. What's different?
I made over 10,000
A bunch
this
of
year.
money to me, 350.
Yeah. Okay. That's good. You
Yeah.
made 350 grand off the side of the
That's
desk.
definitely a bunch of money.
Okay, but let's say it's
But
so
that's not the usual person starting a small business.
but let's just say that you have. Let's do 100 grand. I
All
made
right.
100 grand as a side hustle doing something else.
First thing I tell people, I ask people, is how much disposable income do you have to put into a retirement account?
Good
Because
question.
if you only have 6,000 or 7,000, then do a Roth IRA.
Right.
You don't have to bother with all the administration of a plan. But if you say, well, I'd like to put in 20, 30, 50,000, well, then you have to start stepping up the kind of plans, a SEP plan where you can put that kind of money, your own solo 401k or regular 401k if you have employees. We can have a lot more to contribute if you have the disposable income. But most people say, well, I'm maxing out at work, like you said, my other job, and I don't have that much available. So if you look today now, for 2024, you can put up to 7,000 a year. If you're 50 or over, 8,000 a year, say in a Roth IRA. If you don't have that much, then just do that, and it's nice and simple.
And otherwise, you do have the chance to do a SEP IRA. And
Or your own solo 401k.
and then what's better in that respect? Like, what would you think is a better approach? A SEP IRA or a solo 401k?
Can't you do Roth SEPs now?
Yes, and the answer is yes, but nobody has them. They're available, and nobody knows how to set them up. IRS just put out a bunch of regulations. This is from all that Secure 2.0 nonsense that came out. So complicated. A lot of companies don't want to deal with it. They don't have standard documents where you can do a SEP Roth or a simple Roth.
So you mean like normally, if you
it's
want to do
allowable. I haven't seen one yet.
but it will only become prevalent when you see that like Fidelity offers it, Vanguard offers
when
it,
it
right?
gets into the mainstream, and they're working on it. You're probably better off, you want to go to the Roth, do your own 401k and make it a Roth 401 and have the Roth option. There's no such thing as a Roth 401k. There's a 401k with a Roth option.
And if you have that and you are just working for yourself, can you you can also make
Well, then
a
it would be a solo.
Right. And if you have a solo, is there a way that you can put more than that 23,000?
Oh, yeah. You can put up to this year
50-something,
69,000 if you have the money available.
Right.
That's why I say, not everybody has that kind of disposable income. But if you have the money sitting in a bank account, then yes, if you put it in a Roth, all you're doing is changing pockets, and now it grows tax-free.
I want to mention one other fund.
Oh, and another benefit for Roth 401ks starting this year, 24, no RMDs. That was a thing. That was, I think, an unintended consequence in the tax law that Roth IRAs, one of the great benefits, no required minimum distributions during your lifetime. But if you had a Roth plan at work, a Roth 401k, there were. They fixed that, and now they're the same. So you don't have to worry if you load up in a Roth 401k, you have to start taking money out. That's out for this year. So Roth 401ks no longer have annual RMDs.
So you have also a wonderful cheat sheet about the Secure Act 2.0. Okay, so wait. The Secure Act was 2020 what? 1?
22, like midnight on December 29th,
Yeah.
22.
Okay, but the original one was like the previous.
Was also December 20th. They gave us 11 days then of 2019, effective for 2020. This one, you see the effective date?
Yes.
Yeah.
Enacted, not the effective date, because the effective dates are all over the place. That's why I had to create a chart as a scorecard. But I don't know if you heard the story. It was all over the news that date, December 29th, 2022.
Yeah.
Congress had gone home. The president had left. They had to ship him the bill. He was down in the islands. I forget what island he was, the Caribbean somewhere. And they sent a guy down, and this sounds like a James Bond movie, with the actual like 4,000-page
my
bill.
God.
I'm wondering, is it in a suitcase handcuffed to his hand, or did he put it in baggage, or was it in the
like
overhead?
the football, right, Mark? He got the Secret Service with him.
Yeah. Was it in the overhead? How did it get there? So this one schlub, probably a staffer, went down to wherever he was, Saint something down there, and he signed the bill, and it was effective 2 days later.
And so what's important about this, and the problem that we have with all of these bills, is that instead of just saying this is what happens on this date, there's a rolling set of dates.
Yeah,
that
you can't
occur.
use that video when a bill becomes a law anymore.
No, it's not good. So for
Schoolhouse Rock.
Schoolhouse Rock, exactly. So as of last year, the required minimum distribution went up to age 73. Right. And there were a lot of other things that happened, but that's the one that probably impacts the vast majority of people. Like that RMD age is rising to 75.
9 years now in 2033. So they went out over 10 years in this bill, all budget gimmicks. I don't know how they figure this stuff out. And it made it very complicated. It used to be, and I don't want to sound like an old fogey, back in the old days, when the president signed a bill into law, like on Schoolhouse Rock, it was the provisions were effective as of the date of enactment.
Right.
But now, because of the 10-year budget cycles, they have to Jimmy rig this thing or MacGyver it, whatever you want to call it. Well, we can fit some in 23. Let's put these. Can you imagine them sitting there with the numbers? Well, this generates this kind. Put that at 12. Oh, that brings in a lot of revenue. Push that up to 23. Put the good ones back out later.
So when you look at your age, I love the little box because you really basically
but it's so complicated.
Right?
People were asking what age applies to me because they were so used to 70 and a half. And that was one of the best things that came out of the Secure Act, to get rid of that half year.
Except for QCDs. Where it still
except for
is.
QCDs.
So stupid.
But for people in RMD age, you don't know how. I know it sounds ridiculous, but they were so confused. Am I 70? Am I 71? When am I 70 and a half? I used to have to explain it's 6 months after your 70th birthday. But what chart do I use? What age do I use? When was I born?
Here it is. Born 1950 or earlier, it's age 72.
You went
51
past
to
that.
59, age 73. Born 1960 or later, which is...
That's us.
Thank you very much.
That's us.
Also, I was very happy to note that I'm actually not a baby boomer. Notice my year of birth. Thank you very much.
So you missed the Beatles.
I missed everything. So
60 years ago this month on Ed Sullivan.
I feel like I could start singing right now. So when you look at all of this nonsense, which, right, you said you call
there
it.
are some good provisions.
There's some very
but
good
the way
things.
it's spaced out, the fact that I even had to create this chart, we use it for advisors. I have it on my desk. People call up. What about the 529 to Roth? That's another one that's effective this year.
That's the most popular. In terms of our audience, that's the most popular one.
All right, so let's talk about that.
You know what? I got a little tip for you that I just found out because somebody asked me about it. We didn't have the answer. We found it. All right, so there's a provision, and it's not all it's cranked up to be, but it's effective this year. Let's go back. 529s, qualified tuition programs and all that stuff to save for college. And people were taking advantage of it. Too much so much that people started having $200,000, $300,000 in these accounts and realizing, My kid's got a scholarship. Damn kid got a scholarship. Now what do I do? Or they're a dropout like Bill Gates. They didn't go to school. For whatever reason, these funds were not being used and they were being built up, and you only get the tax advantage if it's used for qualified tuition. We had people retiring, going back to school just to use the money to, go to college. So they put in this provision to try and bring those balances down. But it helps you if you have modest excess balances, because the lifetime limit is only $35,000. But there are so many conditions. First, the 529 had to have been in existence for 15 years.
$1 though. It doesn't mean that you had to have all this money in for 10 years.
It had to be open in 15 years. But then they have another limit. You can't use money that isn't more than 5 years old in the account.
Oh, I didn't know that.
Yeah, there's a 5-year rule on that. So, and it has to be the beneficiary of the 529's Roth IRA. And then it's further limited by the amount the beneficiary could contribute to a Roth. So this year, for example, it's only $7,000. So $7,000 would still take you 5 years to hit the $35,000. $35,000 is a lifetime limit. So the most you can do is maybe $7,000 a year. But even that, if you're doing it, say, for a grandchild, they would have had to qualify for a Roth IRA by having earnings.
Right.
But if they didn't have earnings, then you can't do it. But assuming you qualify on all of those fronts, you can do that rollover, say up to $7,000 a year. But because of the transition rule, we just found out from IRS of all people that you have a one-time break this year, but only up to April 15th. And you heard it first here on Jill on Money.
Yes.
Because the distribution rules say it's only effective for 2024, the question came up, what if I do a rollover for my 529, assuming, you have somebody that all the conditions apply, they meet the qualifications. Let's say they do a rollover from the 529 to the Roth right now, say in February or March or anytime before April 15th. Can that count against the 23 Roth contribution? And the IRS said yes. So you could do one for 23, but that would have to be up to April 15th, the normal deadline for doing a 23 Roth contribution. And then you could do another one. So you could get a double hit for 24 only.
But still has to be open for 15 years, no?
Yeah, all those conditions apply. I said assuming you qualify under all those conditions. And another condition, if you can't do this, if you already put in, if the beneficiary already made their contribution to a Roth for $7,000.
Oh, right.
So if they already did that, then you're maxed out. You can't double dip.
But
I think it's still a good thing, because I think that was a hurdle for a lot of people. Is they're like, well, I don't know if my kid's going to go to college, and what am I going to do with this money?
But not for the big excess. The people that have
not for the hundreds of thousands.
Yeah.
So if you look back and you say 529 plan, you still have to think that this is a fantastic way to save for education.
It is, but I'd rather do it in a Roth IRA where I have no restrictions. As Mark just said, you don't know. Everybody thinks when their kid's born, he's going to go to MIT and all of this, but you don't know.
Can we have a little bit of a moment about health savings accounts?
Okay.
Because this is another one I
got the chart, and that's all I know about
it. That's the
it.
purple one. Well, I want to talk about this because
it is a good way. It's like an IRA for healthcare.
So it's like a Roth IRA for
triple
healthcare.
tax advantage.
Yes,
right?
Yes. Yes.
So can you explain the triple tax advantage?
Well, you get a deduction going in. The money grows tax-free in there. And when you pull it out, if you use it for qualifying health care, it's tax-free. So it's a great provision. It's like a super Roth IRA. And many people, I find, are using it to build dollars for their future health care.
Yeah. And because we know that, every year we get that Fidelity survey that comes out and says you're going to spend $400,000 on health care or whatever it is.
And this is where big money, we talked about the other provision, the tuition. You don't know if the kid's going to school. It's a pretty good shot. You're going to have health. As you get older, you're going to have medical expenses.
I mean, unless you look like Ed Slott.
Yeah.
Looks fantastic. So would you say, generally speaking, if people can afford to use a health savings account, just use it?
Yeah. It's a savings account for an expense. I'd say, what would you say, 95% likely to use?
I think a lot of people make the mistake of using the health savings account, but they don't realize that you can go in and pick individual investments. They just some people just let it sit there in the cash. Like, if you're going to use it, you have to use it correctly. Like, for instance, we use one And I think of it as something we're going to use, 30 years down the road. So it's just 100% of stocks.
Yeah. And for a while, it was hard to find investments for the HSA. So it's not unlike when you said, like, we need to have pickup from the big companies to be able to invest, say, in a Roth SEP. This one, you could be able to, get it going.
No, it's a great, like Mark said, triple tax-free. I mean, it's a great benefit. For an expense you almost know you're going to have. I'd say, would you say 95%?
Yeah, definitely.
Yep.
Okay. Now, Mark, do you have any other questions before we break? And this is the big, because I'm going to make the big tease here.
All right.
Big tease.
You ready?
Which is what? Roth?
Ladies and gentlemen, just wait. Because we're not done with Ed Slott. We will be, but when we have our next episode, guess what? It is all Roth all the time.
Ooh, I love Roth. I love tax-free.
And I'm not changing my outfit. I'm sorry, Nicole, but I'm going to stay in the same outfit because we're still in the same studio. We're all going to have the same outfits. You have a very nice sweater on today.
Thank you.
You look good. You are shiny on your head, though.
It's not there. Your secret sauce is gone.
Gosh darn it. I made him put a little something on his so he didn't shine.
Oh, yeah.
Time.
I have that too. When I used to have hair and everything.
Oh, my gosh. All right. So on our next episode, we are going to have Ed Slott, the man behind the Roth, the man who proselytized the Roth before anyone else did, converted Mark Talercio. He is going to be back, and we are doing all Roth all the time. By the way, gang, don't forget this YouTube channel, which is part of the Confounded Friends. You can subscribe to us. Please like us. Leave us a few comments, but only if they're good, because I have a very thin skin. I want to thank everybody in the studio here, Duncan, John, Daniel, and of course, Nicole, who's not in the studio, everyone at the compound for helping us put the show together. And we always like to remind people to lift someone up, change your work, change your wealth, change your life. Don't worry. We're doing all Roth all the time with Ed Slott. Next program. Thank you for listening. Thank you for tuning in. We'll talk to you next time.